This week, we've had the latest interest rate decision from the US Central Bank, the Federal Reserve. This is what the market did. This is the dollar index. So this is when the rate came out. It was 7 o'clock in the evening, UK time. You can see the volatility over it. They committed to keeping rates low. But since then, we've actually seen dollar strength. So what does this mean for other asset classes, and where might the opportunities be? There weren't really any surprises from the rate decision this week, but there was a couple of things in there to do with their attitude to inflation and how they saw the economy. So I thought, well, let's take a look at some different markets here. This is the dollar index. It's a really interesting market to watch. It's the dollar against a basket of other currencies. And you can see we saw the dollar really rally into late March as investors saw a safe haven, really, in the eye of the coronavirus storm. And since then, we've seen the dollar weaken. But as I've said in a few other videos, I wonder if we are seeing something of a base for the US dollar. So we'll tie that into our discussion on interest rates. We have quite a few trades at the moment that could be affected by some moves in the dollar. Let's take a look. So we've got silver and gold trades running at the moment. And then we have these the euro trades that have been running for some time, some good profit on them. Pound trade that's underwater, dollar yen trade that's also losing at the moment. But then, of course, with interest rates, we have other markets that can be affected. We've got some stock trades running like Apple. So I'll talk about some of the stuff that could be affected by this. We'll look at 3 different asset classes and jump back on to the charts and see where the opportunities could be. Hello, I'm David Jones from Capital.com, and given the fact we've had this latest Fed interest rate decision this week, I thought we would take a look at what near zero rates means for a mix of all these different asset classes. So as usual in this video, I'll talk about what the impact could be. We'll jump on the charts and take a look and see where the opportunities might be. If you're watching this and you haven't subscribed, if you could click on subscribe, it means we can continue to push out 4 videos every week on different markets. And of course, you get notified if you have the alarm bell pushed of when we do our live streams. And I think we've got another one planned in the next few days. But let's talk about the background to all of this. So on Wednesday this week, we had the latest interest rate decision from the US Central Bank, the Federal Reserve. There were no surprises here, but the Fed did say that it expects to keep rates pretty near zero till 2023. So again, just re-emphasizing its policy to keep these rates pretty much near rock bottom. It also talks about inflation. Again, traditionally, of course, if inflation starts to rise, the traditional way of trying to combat inflation is to raise rates. But the Fed did say that it is comfortable with letting inflation go temporarily above its 2% target without having to immediately raise rates. So a bit more flexibility when it comes to inflation, given the economic shock that we've seen to the US and other economies around the world following the coronavirus. It was a bit more upbeat on the state of the US economy this year. It said it expects the economy to contract by about 6.5%. It revised that to about a 3.7% contraction in the economy. So the economy is bouncing back quicker than it expected. But to temper that, it did say in the years ahead, it expected economic growth to be perhaps not as fast as it was expecting. So a shorter term bounce back, but longer term, perhaps the effects of the coronavirus on economies will still be felt for a couple of years at least. So let's talk about how all of this affects market. I think the story is not so much with zero rates, because we know that rates are near zero. We know the Fed has committed before the latest meeting to keep them down here. But let's look at how these affects different asset classes, because I think there are still some really interesting things to watch. So foreign exchange is the first obvious market to look at. And if we look at it from a traditional point of view, if interest rates are going down in a particular region for a particular currency, then normally it would push the price of that currency down as well. We'd have a weaker currency. So if you've got lower interest rates in the US, we'd expect a weaker US dollar. But like I say, that the latest statement from the Fed was hardly a surprise. The US dollar had been weak anyway, and it did in fact rally slightly in the 12 hours or so after the announcement. So the US dollar was not weaker after this commitment to rates for the next 2 or 3 years. The dollar had been falling since March. Plenty of volatility during March for the US dollar, pushed out to a fresh recovery high. But then since March, it's dropped by about 10%. So I think the question we have to ask ourselves here, rather than just assuming low rates means a weaker US dollar, is all of that interest rate effect already priced into the dollar? And actually now, what we need to start thinking about is a recovery in the US dollar. And of course, if we see a recovery in the US dollar, we're going to see currencies that are quoted against it, for example, the euro and the pound, under some pressure. Let's take a look at this. We'll look at the dollar index, then we'll look at foreign exchange pair as well. So let's take a look at FX in a bit more detail. I'm going to look at the dollar index again. I think what's interesting here, as I've talked about in other videos, it clearly how weak it's been. We've had this downtrend that's been in place. And it is sort of trying to break out of it. And what's also interesting, if we focus on what's been going on since perhaps July, August, let's zoom in. So in mid-August, it breaks below the lows from late July, but we don't get any follow through. There isn't like a wave of selling again. And we've seen a similar thing happen in early September, breaking below those August lows, but turning it round. Added into this, looking at the RSI down here, I've talked about this idea in the past, this idea of divergence, where the market's doing one thing, but the RSI is doing something else. And we've got it going on here where the price is making new lows for the down move, but the RSI is making higher lows. It can be a suggestion that perhaps the market, the trend in the market is running out of steam. This weakness is finally coming to an end. I think we really need to see the dollar index clear 94. It's currently trading at 93.20. So if we clear 94, perhaps the market gets a move on and we see a better recovery back up to July levels at 98. But I think it's a really interesting market to watch. So what I'm going to do anyway is place an order to buy if 94 gets broken. So if this market trades up to, let's say 94.20, I'd like to be a buyer, and I'm going to put a stop the other side of that September low. September low was 91.70. Let's go 91.50. So I'm a buyer at 94.20 with a stop at 91.50. Let's set that up. So I'm ready to go. So the market's currently 93.20. I'm going to buy 120 contracts. If the price gets to 94.20, if that gets filled, put a stop at 91.50, the other side of that September low. Because if it breaks that low, it looks like that downtrend is still in place. And it's for our new risk of £250. Let's place that stop order. So I'm not saying I'm definitely expecting a rally, a recovery in the US dollar. I just think it's interesting that it's perhaps not reacting as we might expect it would. But if we do see a bit further strength from here, I want to be in on the trade in case we see a real recovery kick off for the rest of this year. So let's talk about a couple of, which I know are popular assets with our viewers, gold and silver. Again, going back to the weaker US dollar argument, if lower interest rates meant automatically a weaker US dollar, then you would expect the price of gold and silver to be lifted. They do move inverse to the direction of the US dollar. But of course, we need to balance that against the fact that is all of this already priced in for the dollar. But also with lower interest rates, it makes other asset classes more attractive. What's the point in having your cash in a bank lying around, not earning any interest, when you could put it in an asset that may appreciate? So again, lower interest rates you would think would help the likes of gold and silver. But this is somewhat of a loose link. If you look back to the 1970s, we had rising rates, but also the price of gold was rising as well. Look back to the 1980s, we had falling rates, but we also had a sliding price in gold. So I don't think we can just pick up on that direct correlation. But what is interesting here, I think, is this inflation argument. At the moment, no one's worried about inflation, but the Fed said that it's quite happy to see inflation go temporarily above its 2% target. I think if we do see inflation start to be a problem in the future and start to rise, then that you would think would help the likes of gold and silver, with people using these metals as a hedge against inflation. So I think it's what they've said about their attitude to interest rates and inflation that could be the really key thing to watch for gold and silver from a medium to longer term point of view. Plus, of course, why are rates so low? Because the Fed is worried about the state of the economy. If the state of the economy is a concern, if investors are nervous, traditionally assets such as gold and silver will perform well. So I think there's the signal there, which we've seen so far this year with the great performance for these precious metals. Investors view them as a safe destination, an alternative home for their cash. Let's take a look at these two markets. We regularly look at gold and silver, of course, in our weekly videos. So let's have a quick look at these two markets. So here's the gold price. Of course, we start with our trend from August 2018 lows. This then accelerated from March this year and punched up to all-time highs at 2,075. We've seen quite a bit of volatility in the week or so after those new all-time highs were hit. The market turned around by $200. And since then, it's just been sideways. But for me, it doesn't really change anything. You know, we can't have exciting volatile markets all the time. I think that trend for gold is still up. I think in the short term, it's only if we lose 1850 does it start to look as if we could see a bit more pressure on the price. But it doesn't change that picture of the longer term trend. So for now, I'd still be quite happy to be a buyer on dips for gold. It's a similar story, of course, with silver. We do have some orders in at the moment on silver to buy if it slips back to 24 or to buy into strength if it breaks above 30. Not much has changed since we last looked at silver earlier in the week. We have this trend from the March lows still chugging along. So we're, 6 months into that. We've got good trend support coming in ahead of $22. It's currently trading just below 27 at the time of recording. So I think that the bias for silver is still positive. If we did see it under pressure from here, if we've got a bit of US dollar strength, perhaps, I'd be quite happy to be a buyer looking for these old levels at 22 to hold. So a little bit quiet over the last month or so, but that trend still very much in place. And then finally, stock markets. As a broad rule of thumb, lower interest rates are good for stock markets. If rates are under pressure and falling, we would normally expect stock markets to be going the other way and rising. Pretty obvious, I think, what the reasons are. First of all, what's the point in having your money in the bank earning nothing in terms of interest? Investors will seek out better returns in other markets. The stock market is a traditional home for that cash. Plus, of course, the fact that if you want to, you can leverage, you can borrow money at a relatively low rate and take on some risk and look to get a better return somewhere else. So low rates traditionally help stock markets. But we need to balance that against where stock markets have come. We've seen this fantastic recovery off the March lows for stock markets with both the Nasdaq and the S&P 500 pushing out to fresh all-time highs. The low interest rate is hardly a surprise at the moment. So I think we just need to balance that off and think, okay, well, how much of this is already priced into the market? And of course, don't forget, the reason we've got low interest rates is because the Fed and plenty of central bankers and governments around the world are worried about the economy. They're worried about the pace of economic recovery. If we do get some economic shocks, this is probably not going to be good for stock markets. So I think we need to balance off the fact we can get cheap money with what the economy looks like over the next 3, 6, 12 months. If we see some shocks there, we could see a lot of volatility for stocks. Let's take a look at stock markets and see where opportunities might be. And here's the S&P chart. So the broader US stock market index, it has, of course, been quite the year, as we know. Moved out to all-time highs in February this year, up at 3,400. Then, of course, fell off a cliff into March. And since then, we've seen this incredible comeback by the S&P, setting fresh all-time highs right at the beginning of September. Quite volatile since then. But I think something of a welcome correction. I think from a trading point of view, it was perhaps getting a little bit boring for some of us, seeing just these day in, day out rises for the market. So I think we have a much more interesting market going into the end of the year. But these trends are still up. You know, we've got good support coming in from 3,200 for the S&P, the lows from the summer, mid-July lows, more recent support at 3,300. So again, for the S&P, I'd still be tempted to be a buyer on dips, to be honest. I think if we did see any pressure through 3,200, perhaps we have a slightly different market and we see anybody who's been in this rise all the way up taking some more profits. But for now, while above 32 to 33, I think the bias for the market still clearly up. I'd be looking for a return back to those all-time highs at 3,600. But for now, we've clearly lost some of that really positive momentum we've had since March. But for me, there still appears to be the appetite to be a buyer on dips. Just watch this old 3,200 level, because I think if we break that, we could see some deeper sell-offs. So no real surprises from the Fed this week, but I do think, there are certain things we can take away from this, particularly inflation when it looks towards other assets, and particularly, of course, their attitude as to why rates are so low, because they are worried, quite rightly, I think, like plenty of us, about what the economy looks like. That's it for this update. We'll leave things there. So from me, David Jones, and Capital.com, good luck with your trading. For more trading videos just like this, please subscribe to our channel.